In 2017, a coffee company opened its first store in Beijing. Nobody paid much attention. By 2019, that same company had more locations in China than Starbucks had built in 20 years of trying. Wall Street was calling it one of the great growth stories of the decade. Institutional investors were buying in. Analysts were raising their price targets month after month. Then a plain envelope arrived at a financial research firm in New York. No explanation. No signature. Just a document inside, 89 pages long, that alleged the entire company was built on invented numbers. The stock would eventually lose 75% of its value in a single morning. The CEO would be removed. The COO fired. The company fined $180 million by American regulators. And the person who wrote those 89 pages, the person who started all of it, has never once come forward to take credit. This is the story of how a phantom built and destroyed a $3 billion empire. And why the empire is still standing. To understand what Luckin Coffee was, you have to understand what it was selling itself as. China in 2017 had a coffee problem. Not a shortage of it, but a ceiling on it. Starbucks had arrived in 1999 and built a near monopoly on premium coffee culture in Chinese cities. Their stores were aspirational spaces. The price point reflected that. For a generation of younger Chinese consumers who wanted coffee as part of a daily routine rather than an occasional treat, Starbucks was simply too expensive to visit every day. That gap was real. And Luckin was designed specifically to fill it. The founders, led by CEO Jenny Qian Zia and Chairman Charles Lu Zhengyao, came from a background in car sharing and logistics, not hospitality. They approached coffee the way a tech startup approaches any product, as a data problem. The model they built was deliberately frictionless. There were no cashiers. There was no menu board to stand in front of. You ordered through an app, you arrived at the pickup counter, you took your drink and left. The whole interaction was designed to take under 90 seconds. To drive downloads and build habit, Luckin flooded users with coupons. Free drinks. 50% off. Buy one get one. In the early months, many customers were paying almost nothing for their coffee. This raised an obvious question that most analysts asked and then moved past. How does a company that gives away its product ever make money? The answer Luckin gave was always the same. They were in a land grab phase. Capture the users now, build the data asset, introduce premium products and advertising revenue later. It was the language of Silicon Valley applied to a coffee chain, and in 2017 and 2018, that language still had enormous credibility with investors. So people believed it. And when you believe a story that strongly, you tend to stop looking for reasons it might not be true. By the time Luckin filed for its American IPO in April 2019, the company was barely 2 years old and had never turned a profit. That alone would have killed a conventional IPO. But Luckin wasn't positioning itself as a conventional business. It was positioning itself as a technology company that happened to serve coffee, and by 2019, technology companies with massive user growth and no profit were not only accepted on Nasdaq, they were actively sought after. The IPO raised $651 million. The company listed at $17 per share. Within weeks it was trading significantly higher. What the prospectus showed was a company growing at a rate that seemed to validate everything investors had been told. New store openings were accelerating. App downloads were climbing. Monthly active users were increasing quarter after quarter. What the prospectus could not show, because audited financial statements can only verify what companies report rather than what actually happened on the ground, was whether any of those numbers reflected reality. There was one analyst who looked at Luckin's disclosed financials in late 2019 and noticed something that didn't sit right. The revenue growth numbers and the user growth numbers were moving in the same direction, which is expected, but the rate of increase in revenue was outpacing user growth by a margin that was difficult to explain without assuming that each individual customer was spending significantly more over time. That assumption isn't impossible. But it is the kind of thing that deserves scrutiny. The scrutiny didn't come from the analyst community. It came from somewhere else entirely. In January 2020, a package arrived at the offices of Muddy Waters Research. Muddy Waters was founded by Carson Block and had built a reputation over the previous decade for exposing fraud at Chinese companies listed on American exchanges. They had been right often enough that their research reports moved markets. When Muddy Waters published something, people paid attention. But they hadn't published this. They had received it. The package contained an 89-page document. Whoever produced it had not included any contact information, any firm name, or any indication of who had funded or commissioned the research. What they had included was evidence on a scale that was genuinely difficult to process. The authors of the report had organized what amounted to a private investigative operation across China. More than 1,500 individual contributors had been deployed to sit inside Luckin stores across the country, filming customer activity and manually recording transactions for 981 store days worth of observation. To put that in context, 981 store days means the equivalent of watching a single store, every hour it was open, for nearly 3 years. Spread across hundreds of locations simultaneously. 25,000 individual customer receipts had been collected and preserved. Data from third-party delivery platforms, which Luckin used for orders placed outside their app, had been scraped, aggregated, and cross-referenced against the revenue figures Luckin had reported to investors. The conclusion the report reached was that Luckin had inflated its revenue per store by at least 69% in the third quarter of 2019. In the fourth quarter of the same year, the inflation was at least 88%. In practical terms, the report was alleging that for every dollar of revenue Luckin told investors it had earned, roughly half of that dollar had been invented. Muddy Waters spent several weeks going through the document before deciding what to do with it. Publishing anonymous research is a serious decision. If the underlying work is wrong and you put your name on it, you face legal action and permanent damage to your credibility. If the work is right and you bury it, you are sitting on information that millions of investors would consider material to their financial decisions. They published it on February 1, 2020. Luckin Coffee's response arrived quickly. The company issued a statement calling the allegations in the Muddy Waters report false, and the methodology flawed and misleading. They said the report was the work of parties seeking to profit from a drop in their stock price, which was technically true of short sellers by definition but didn't address a single specific number in the document. What happened next was the part of this story that doesn't get discussed enough. The stock dropped when the report published. Sharply. Then it recovered. Within a matter of days, Luckin's share price had clawed back most of what it had lost. A significant portion of the institutional investors who held the stock looked at the company's denial, weighed it against an anonymous 89-page document from an unknown source, and decided to stay in. This is not irrational behavior. Anonymous allegations against publicly traded companies are common, and short sellers have a financial incentive to make stocks drop. The responsible approach in most situations is to wait for verifiable evidence before making decisions. What made this situation different is that the verifiable evidence was sitting in Luckin's own internal systems. It would just take a few more months to surface. In February and March 2020, Luckin's stock actually continued to trade at elevated levels. New investors were buying in. The company was opening new stores. On the surface, nothing had fundamentally changed. Then Luckin's board announced something that nobody had been expecting. They were conducting their own internal investigation. The announcement came on April 2, 2020. Luckin Coffee's board disclosed that an internal investigation had found evidence of fabricated transactions totaling approximately 2.2 billion yuan across a period of roughly 9 months in 2019. At the exchange rate at the time, that was approximately $310 million. The person named as primarily responsible was Lu Jian, the company's chief operating officer. What the investigation described was not a complex financial engineering scheme of the kind that requires sophisticated understanding of accounting rules to pull off. It was considerably more direct than that. Employees under Lu Jian's direction had created corporate customer accounts that didn't correspond to real companies. Orders were placed against those accounts. Revenue was recorded against those orders. The recorded revenue flowed into the financial statements that Luckin's auditors reviewed, that its executives signed off on, and that were filed with American regulators as the basis for investors' decisions. The auditing firm was Ernst & Young, one of the largest and most respected in the world. They had reviewed the financials and found nothing wrong. This is worth sitting with for a moment, because it tells you something important about how financial fraud at scale actually works. The auditors were not negligent in the way that is easy to imagine, where someone simply failed to look closely enough. The fabricated transactions were constructed to pass audit review. The fake corporate customers had documentation. The fake orders had records attached to them. The fraud was designed specifically to survive scrutiny. And it did, until someone on the inside decided to look beyond the documents. The stock fell 75% on the day of the announcement. In the space of a few hours of trading, approximately $5 billion in market value ceased to exist. What followed was the predictable machinery of financial scandal. Lu Jian was dismissed. Jenny Qian, the CEO, was suspended and later removed. The company's founder and chairman, Charles Lu Zhengyao, resigned. Nasdaq suspended trading in Luckin's shares and began the process of delisting the company entirely. The Securities and Exchange Commission launched an investigation. In December 2020, Luckin Coffee agreed to pay a $180 million fine to settle the sex charges without admitting or denying the findings, which is standard language in these settlements and means less than it sounds. In China, regulators took their own action. The company paid additional fines under Chinese securities law. Several individuals faced legal proceedings. The coverage of these events was extensive. For several weeks in the spring and summer of 2020, Luckin Coffee was one of the most discussed corporate fraud cases in the world. And then the attention moved on, as attention always does. What the coverage mostly missed, or mentioned briefly and moved past, was what Luckin was doing while all of this was happening. It was still making coffee. Every store stayed open throughout the investigation, throughout the SEC proceedings, throughout the delisting. The baristas showed up. The app kept working. Customers kept ordering. The company that had been exposed as a fraud was, in the background and without making much noise about it, continuing to operate as a business. This is the element of the Luckin story that most people who followed it in 2020 don't know, because they stopped paying attention before it happened. Under new management, Luckin restructured its finances, renegotiated its debts, and settled its obligations with regulators in both the United States and China. And then it started growing again. The unit economics of the business, it turned out, were not entirely fictional. There was a real market for affordable, app-based coffee in Chinese cities. The fraud had inflated the numbers, but the underlying concept had genuine commercial viability. By 2022, Luckin was profitable. Genuinely profitable, with real revenue and real customers. By 2023 it had passed 10,000 locations. Today it operates over 20,000 stores across China. That is more than double what Starbucks has built in the country across a 25-year presence. The company that fabricated hundreds of millions of dollars in revenue to convince investors it was growing now has the actual growth it once pretended to have. The executives who oversaw the fraud at its peak received financial penalties and in some cases faced Chinese legal proceedings. The consequences, considered against the scale of the harm done to investors, were limited. Starbucks, the company Luckin was supposedly racing against, has spent the past 3 years watching its Chinese market share decline as Luckin expanded. The fraud worked. Not in the way that was intended, and not without serious consequences for the people who ran it. But the company it was designed to build is the company that now exists. There is one thread in this story that has never been resolved, and that most of the reporting on Luckin Coffee has treated as a footnote rather than the central mystery it actually is. The 89-page report. Think about what it would take to produce that document. You would need to recruit, coordinate, and manage over 1,500 people across multiple Chinese cities without any of them talking about what they were doing or why. You would need to establish a system for collecting, organizing, and verifying 25,000 individual receipts. You would need the analytical capability to process delivery platform data and map it against publicly reported financials in a way that would survive scrutiny from professionals at one of the most prominent short-seller research firms in the world. You would need funding, because operations of that scale cost money. You would need time, because the data collection alone represented months of coordinated work. And then, after you had produced something that moved global markets, triggered a federal investigation, and resulted in one of the largest SEC fines in the history of Chinese corporate fraud cases, you would need to walk away from it completely. No credit. No press release. No anonymous interview. Nothing. Muddy Waters has said publicly that they have no idea who produced the report. The SEC, which would have significant interest in identifying the authors given questions around whether they held short positions in Luckin's stock, has not publicly named anyone. Nobody has come forward. Nobody has leaked. Nobody, in 5 years, has said a word. The fraud is documented. The company is thriving. The regulator was paid. The executives moved on. And somewhere, there is a person or a group of people who know exactly how all of this started, who know the answer to the one question that nobody has been able to answer, and who have chosen, for reasons that remain entirely their own, to say nothing. That silence is the most interesting part of the entire story. And it is the only part that remains completely unsolved.